This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. This is Chris, and happy March the 5th. Hard to believe that just seems like not too long ago we were celebrating New Year's Eve, but what, 2 months of the year's already gone by, and to me the popular hashtag is tired of winter. So I hope all of you are doing well. Let's go ahead and get started. Try to get through here a little quicker than normal. I said that last month, and I think I lied to you, so I'm gonna try a little bit better this month. So as a reminder, everyone, that the Kimble charting solution and the power of the patterns, your 30-second solution to investment research. We hope to show you some patterns that increase the odds of being correct, that empower you, that you can make decisions without spending a lot of time, and then go spend time with your family and friends and your business and just doing some things that are fun. As a monthly reminder, we're not a bullish or a bearish shop. We don't believe in taking certain mindsets about this is the way things have to turn out. We are bullish on one thing though, and we're bullish on the power of the pattern and opportunities that come from knowing pattern analysis and its repetitive behavior and nature's repetitive, or people's repetitive nature, when we see extreme fear and greed come into play. It's hard to believe that a year's passed by, but for those that are welcome to the new members, we appreciate new and old members. And for those of you that have been around a year, it was on February the 28th of last year that I sent an email saying that due to a few different pattern circumstances and sentiment readings, the pattern circumstance was that a lot of the markets were testing the Fibonacci 261 levels off the 2007 highs and 2009 lows, that we thought the 800-pound gorilla was sitting overhead, and that we should be, if some repetitive patterns of the past would reoccur again, our theme was be comfortable with home on the range. And what do I mean by home on the range is that we started sharing on February the 28th that I thought we would be range bound, that the market would start a new chopping process for an extended period of time. And I'll go ahead and show you why I felt this way a year ago. But this looks at a chart on the S&P, and the Fibonacci extension levels are applied to the 2007 highs here that the arrow is highlighting, and the 2009 lows. And this is the first major extension level coming out of those highs and lows, which would have been the 161% extension level. And you can see when the S&P hit this level, it just kept knocking and knocking and knocking on that door for almost 2 years. And essentially, in hindsight, one is never for sure, and I fall into that category, that this was a sideways range that was going to be for sure. We felt confident. We shared with members at that time that, again, that this is heavy resistance until broken. And in hindsight, as we look back, it was building a higher level base to push higher off of. And you can see an ideal technical situation was it broke above the 161 level, came back down to test old resistance, which had been there for almost 2 years, which became new support, and then the S&P powered higher for a 50% gain in around 12 months. So a year ago, we were pushing just on the underside of the 261 level, and this highlighted box at the top says on 228. That's why I shared earlier that we thought that there was a high odds due to pattern analysis and sentiment readings that the market at best would be choppy for an extended period of time. And if you'll remember, as the 2018 finished out, well, let me go backwards. As 2018 began, like 90% of the assets in the prior 12 months had positive returns. And then as we finished 2018, there was only like 3% of assets had a positive return in 2018. So it was a year that pretty much stunk it up for asset allocations. It didn't matter, large caps, small caps. Let's go diversify overseas. Oh, that gets thumped. Let's buy metals. That gets thumped. Let's diversify into bonds. That gets thumped. And the only thing for 2018 that did okay, it wasn't a lot to brag about, was cash gained a lot of purchasing power. So again, we felt like a sideways chop would take place, it would bring about opportunities. That doesn't mean opportunities don't exist, but I think that the number one thing is mindset. What is the mindset that we need to be open to from a greater than odds chance of what's going to take place? And so a year later, I'm going to say, I think you still need to be open to a trading range, still choppiness taking place, because until it's taken out, the 261 level, up there is the 800-pound, gorilla. And so if it gets taken out, just like it did in 2016, look for much, much higher prices. But until it does, it's pretty heavy resistance. So this is at first, I know this looks really busy, everyone, but just bear with me for a second. Go to the lower left-hand side, and this is nothing more than a performance analysis of different assets since we shared on essentially the March 2018 Connect series, just like this, when we started sharing. I think we're going to be in a sideways chop. Don't look for a lot of gains from a buy and hold perspective. You got to trade smaller, trade less frequently, be open-minded to frustration. But in time, just like the 20 months that took place in 2015 and prior to the 16 breakout, folks, that 2 years of frustration led to huge gains. So don't let any sideways chop, even though we think it could still continue. Don't let it frustrate you. Just sit there and look in the mirror and say, wow, this could be a base for further opportunities to the upside. So then turn to the right side on this right-hand column, and this is the performance of several different assets since February 28th. Well, essentially, just a year ago. February 28th, as you all know, was last week. And so what this, the NASDAQ is +4, small caps +4, Dow +3, S&P around +3, mid caps almost +3, gold miners up 2, government bonds up 90 basis points, transportation's down 22, gold down 275, and silver down 8% or 800 basis points. So I should have put in emerging markets in some of Europe, and they would have been even further down because they've been weaker than stuff in the States. But just to kind of let you know that this has panned out pretty much like we thought that it would create nimble opportunities. But for the most part, this doesn't surprise me with the heavy resistance being, overhead. And so this is a look at the S&P in the upper left, everyone, Dow's in the upper right, QQQ, the NASDAQ ETFs in the lower left, transportation's in the lower right. We've applied Fibonacci extension levels to each of these at very important emotional highs and lows. You can see that each came up there and came extremely close or tagged the 261 levels, or in the case of the NASDAQ in the lower left, it tagged the 161 level of the 2000.com high and the 2002 low after it fell 90% in a couple of years. And so the red arrows reflect heavy resistance that's in play. But despite a lot of people in social media and on TV thinking the world was coming to an end, the sky was falling after the recent decline into the Christmas Eve lows, my bone of contention is that each of these reflect a series of higher lows for nearly 9 years. And each time these lows have been tagged, most of them, the last time they tagged this rising support line was in 2015, but they hit these on Christmas, around Christmas, the December lows, Christmas Eve. They could have broken, but so far they did not. And so from a long-term trending perspective, the mindset is the long-term trend is still up. There was obviously a large decline, and that's why we tried to say a year ago, be light on your positions, let cash be your friend, try to look at avoiding declines and capital appreciation as opportunities. And so as all of you know, we've tried to do some buying over the last 60 days in several places, and it's rewarded us well. And so we weren't sitting around trying to lick our wounds from big losses, and we tried to take advantage of the dips and emotional extremes of 60 days ago. One of the things that I shared in last week's Global Trends newsletter is, I just wanted to kind of pose the question, are you a fighter or a follower? and I'm going to read a little bit of this. I found that in this business, you usually have to make mistakes in order to come up with something that really works. And in fact, the whole idea of creating the Global Trends Report, which uses long-term support and resistance lines as trend indicators, came to me as a result of some of the mistakes that kept me out of major market moves. I'm not going to pick on anyone, but when I got into this business in 1980, I want to get all kinds of credit that Robert Prechter with the Elliott wave in the early 80s, everyone. I know some of you may not have even been born yet, but he was white hot. When I got into this business in the early 80s, everyone, the Dow was at 1,000, and it had been at 1,000 since 1965. So if you just draw a horizontal line and write the word 1,000 on it, the Dow had banged up against that thing for a decade and a half. And so as I got my securities business and tried to talk to people about, buying stocks, it's like, Chris, don't let the door hit you on the backside on the way out of our house. Interest rates were double digits. Treasury bills were 18% in, around 1982. Gold had hit 850 an ounce. So people were interested in CDs at the banks. They were interested in money markets and they were interested in gold, but for sure not stocks. But Prechter, at that time talked about that, hey, stocks are ready to embark on this huge rally. And he was actually correct. The thing where he kind of went off the road is he became a fighter after the 1987 decline. He labeled, this was wave 5 of 5 of 5, and that was the end of things. The dark ages, were here. And I learned a lot from that point. I'm really glad that I witnessed it and experienced it. And if I can help any of you not experience some of what I did is that I changed at that time to be a follower versus a fighter. And Ben Franklin, said things, which hurt, instruct. And so just to continue to read, many have been a fighter of the uptrend of stocks for years and years and years. I see it in emails, I see it in social media, and many have been a fighter of the downtrend in metals for years and years and years. This can't be true. It's got to be over. It's got to be over. It's got to be over. And, well, the trend in stocks will change sometime, and the trend in metals will change as well. But the one thing at the bottom, folks, I can't emphasize enough: markets aren't wrong. And I'm amazed how people said, oh, the Fed has come in and they've manipulated this market and all kinds of things, and that's why it's rallied. Well, what about the manipulation, on the downside? Did they make it go down? And I'm just not a believer of that. I think it's just a waste of our time to get really caught up in some of that stuff. So again, markets aren't wrong, but mindsets and positions can be. And if you see somebody really at the water cooler, a friend, a neighbor, or whatever, just saying, oh, these markets are broke and they're not acting well, that's just a really strong hint that they're positioned incorrectly, because again, the markets aren't wrong. So I want to encourage you of the different newsletters that I try to share and empower with all of you. I really believe that the Global Trends newsletter is the most important, because folks, if you can get the big trend right, a lot of things is going to take care of itself. And if you're fighting that trend, even if you're a good trader, if you're wrong about the trend, you're going to make a lot of different trades. Get out too early, be buying incorrectly. So again, I encourage you to be a follower versus a fighter. So one of the things I think people have fought in the rally is from a good perspective is the advanced decline line. This looked at the weekly advanced decline line, and one of the things that we've been sharing, for 8 weeks now, is that there was a bullish divergence taking place around Christmas, that as the markets were taking out and creating new lows for 2018, the advanced decline line around Christmas did not break the February lows. And so that was our first little hint that, despite the sentiment that we'll look at shortly, as you lifted up the hood, as Ross Perot would say, and you looked underneath, that was a positive sign that maybe some upside action was to take place. And again, we're not a bull or bear on these things. We're just trying to empower, share with you opportunities to try to take advantage of. And so as you look in the upper right hand of this chart, as of currently, even though the S&P, the Dow, NASDAQ, the New York Stock Exchange is not at all-time highs, the New York Stock Exchange advanced decline line is. And so at the moment, this is a positive, reflecting some strength underneath or internally in the marketplace. So I'm going to shift now for a few charts kind of on the sentiment side. to go back a year, and this is the gray lines, the S&P. This looks at smart money, dumb money from sentimenttrader.com. Great website that I've been a member of a long time. But this blue circle looks at around a year ago when we suggested that don't be surprised to enter a trading range or for people to be frustrated from a buy and hold perspective. Dumb money was very lofty. Dumb money was confident. When dumb money is confident, markets don't have to peak exactly at that time. But historically, when dumb money is really confident, markets tend to be closer to highs than lows. And smart money, the blue line, when it was low, was very cautious. And so we saw that again into fall highs, but not quite as much of extremes. But there's one thing that sticks out to me right now is that the dumb money currently, well, let's go back to the Christmas Eve lows. You can see that the dumb money was very scared. And this is where we went in and took our first purchase of buying mid caps around on January 2nd to start out the new year. And I think we closed out that position with, we all know 15% plus gain. It's closer to 20, I believe. But regardless of the markets across many of the, the popular indices, they've done well since these extremes. You can see that smart money was confident and dumb money was very scared. So two things jump out to me right now is the dumb money is very confident again. And you see smart money being somewhat concerned, not extremely concerned, but definitely close to some of the lowest levels of the past year. So here's a broader look at that same piece, everyone, going back, about 4 years, just to give you a perspective. So this is a net spread between smart and dumb money. And historically, when the ratio is very low, markets are closer to highs than they are lows. And then when the ratio is high, so you can see this was the February low of last year, and this was the Christmas Eve low. Then this was the January high, and you can see when it was very low here, that was the October high. But this isn't bulletproof, everyone. It's a lot better at helping us with lows than highs, because you can see, even though this indicator was very low in January of 17, that's when the markets did pretty darn well for almost a year. So again, it's better at helping us pick lows. And you can see in the summer of 2017, look where the indicator had popped way up here, and that's when things really took off into the end of the year. So it's at one of the lower levels that we've seen over the last 5 years. And again, this is from sentimenttrader.com. So this is they look at, don't quote me on this, but I believe it's 30 some different indicators. They throw them in a pot and they stir up the witch's brew, and they look to see how many of these sentiment indicators are optimistic and how many are pessimistic. And so when this indicator is high, stocks are often closer to highs than lows, and when this indicator is low, stocks are often at good levels to be picking them up. And so again, you can see a year ago where it was. This was another one of the reasons that we said don't be surprised that a lot of choppiness takes place. Here's the the spring lows. Here was the fall highs, and then there was the Christmas Eve lows. And so you can see there's a lot more. In other words, what this would be indicating now, there's a lot more indicators expressing excess optimism than pessimism. And this one's similar in vein to the one that we just looked at. Just because it's high does not mean the market has to peak at current levels. It's actually better at finding bottoms than it is tops. But again, we are at levels where the October highs took place and a little bit below where the January a year ago highs took place. So this is a look from the American Association of Individual Investors, the bull-bear spread. And so when we started suggesting a year ago, as the markets were close to the 261 fib level, hey everyone, look for choppy markets. Don't be surprised if things are frustrating. Part of that reason again was the sentiment levels. You can see over the last 5 years there was almost 60% bulls, and bears were very hard to find a year ago. And so that led to a sideways chop and frustrating year for a lot of different systems. One of my favorite phrases that I don't know where I've heard it over the years, but every good strategy has its weak points. And one of the biggest challenge for moving averages, which are great tools. What are moving averages really great about is if there's a significant uptrend, the markets are above moving averages, so that's real easy. In a significant long-term downtrend, the markets are below moving average, which would signal, hey, lower your exposure or be out. But when markets chop sideways, they say, they're above moving averages, then they're below, and then they're back above. And you can, they always say a good idea is to not watch sausage being made because it isn't very pretty. Well, that's kind of what can happen in sideways chops and with moving averages. And so I still feel we're in this trading range. And so I kind of want to say, hey, be careful. Moving averages aren't broke, but this is a type of environment where they can tend to be very frustrating to people because markets can trade back and forth, and whipsaw people a lot. So current conditions, you see that it is hard to find bears right now. The bearish level is not quite as low as a year ago, but it is at levels seldom seen over the last 5 years. On the flip side, bulls are not, I wouldn't say lofty. They're up there a little bit above mid-range, around what the 42% level you can see, but not nearly what they were 1 year ago, which was the 60% level. So a lot of people are much more concerned than they are optimistic. And I don't know about all of you, if you think about, ask yourself this question: when's the last time I heard about the Dow going to 30,000? When's the last time I heard about the S&P going to 30,000? When's the last time I heard that the economy's doing really well and stocks are just going to go rip snorting through the year 2019? And I think I hear that a lot less than I hear about we got a recession on our hands and stocks are going to fall apart and things aren't good. And that's the, you want to ask yourself, what is the easier information to find in today's world? And oftentimes that can, to me, give you important clues. So I think from a very, very, we've now kind of looked at some larger term perspectives of the overhead resistance. I just kind of want to look now at a little bit shorter term perspectives. We've got the S&P daily on the left, and we have banks on the right. You can see both are below the highs of last year. The S&P made highs in October. The banks started creating a bearish divergence in a year ago, and you can see that they created lower highs, which was a bearish divergence to the broad market. So regardless, right now both still are below last year's highs, and they're kissing the underside of potential horizontal resistance. So we've had this really sharp comeback off of we'll just call it the Christmas Eve lows, and now we're at to me a really important junctures that we're testing lower highs. And so this little, if you saw the movie Witness from Harrison Ford, this was the little boy that witnessed a bad experience. I believe it was a murder. And so the bullish case does not want to witness or see selling start taking place as these key indices are kissing the underside of new resistance. So I'm going to now go through a couple of cases that I want to say are longer term charts. I like the phrase low odds, high impact. So we're going to go through a few charts, and and why I say low odds, folks, with the S&P, the NASDAQ, and the NYSE breaking the advanced decline lines, hitting all-time highs, the odds of us topping here are not eliminated by any stretch, but they're reduced because there's some underneath strength. But my job is to, my mom and dad used to really get mad when I'd ask the question, what if? And so I'm a what if guy. And so when I look at chart patterns, I think I have to share with my valued customers what ifs from chart patterns. So we're going to look at a few that the question is, what if these are topping patterns? And so this is a singular look at the NASDAQ 100 ETF, the QQQ, with the Fibonacci applied in the left side to the 2000 highs and the 2002 lows. This huge rally off of the, what would that be, an 18-year rally, is now touching the 161 level of the 2000 high, 2002 lows up here at 1. And this is a monthly chart, everyone, to kind of get a little bit of the noise out. But there's a chance, and to me this is a low chance, but again, low odds, high impact. This could be a head and shoulders topping pattern that's taking place over the last year. So this would be the high of a year ago, and then the decline into the spring, and then a rally into the fall, into September, October. We see a monthly bearish hangman pattern take place almost as it kisses the 161 level. Then we had the decline through Christmas Eve, and now we're coming back, and we're about at the same levels as the year ago highs. And so again, I think this is low odds, high impact. And so what would it take to blow this pattern up that it's an incorrect read? And it'd be nothing more, everyone, than breaking above the 183 level. If it takes out and breaks above the 161 extension level at 183, this would be a waste of your time. But because of how important a long-term topping pattern could be, you got to remember, you probably heard the phrase that bottoms are often events and tops are often a process. And so, you know, the bottom in 2002 didn't take too long, and the bottom in 2009 didn't take too long. But if this is a top, there's a chance it's taken a while, maybe a year to form. So again, it would take a break of the lows of last year, which would require QQQ to fall below 150. You know, there's two things. What would it take to prove that this is a false read, that's not in play at all? It would be a break above 183. And then what would it take to increase the odds that this is a topping pattern? And if you kind of picture that there's a neckline from around the 150 levels, which is the lows of this last year, if it breaks below that, then it would increase the odds that, hey, we got something much bigger on our hands. So we're going to switch now. Even though that was a long-term chart, we're even going to stretch things a little farther out and a little broader. So this is a chart of the Wilshire 5000 on a monthly basis going back 30 years. So over the past 30 years, the Wilshire spent the majority of those 30 years inside rising channel 1. And so it hit it in 2000, and then this is the next time to hit it was back here in last year. And so if you look down in here, this is the blow up of the blue shade above. And you can see this was a heck of a bearish reversal hammer pattern on a monthly basis right at the top of this 30-year channel that took place in the month of September of last year. And so again, this is another low odds, high impact. The trend is still up, everyone. It has not broken its long-term 9-year rising support. It definitely tagged that line, which is not drawn, you know, at Christmas. But again, I want to empower you that this could be, it's far from proven, but this could be a topping pattern at the top of this 30-year channel by an extremely broad indice. Another one that we want to be watchful of, this is the Dow Jones Utility Index, again going back over 2 decades. But I wanted you to see from the Dow Jones Utilities what they looked like in 2000. And one of the things I want to point out is, you know, that we did see this little spike above. You could make a case, well, maybe that's a head and shoulders. But the bottom line, there was a level around the 400 that just kept banging and banging and banging up, against this resistance level, and it finally failed. But one thing that I noticed as I was overlaying the S&P with utilities is the S&P was already starting to create lower highs, and then once the utilities gave up the battle and started heading south, that's when everything went south with it. So again, utilities weren't a leading indicator. In a way, they were lagging, but then once the lagger started to join in on the downside, and if you could imagine drawing a rising support line, once it broke that, then Katie barred the doors, selling pressure ramped up big. So now turn the table to 2007 and 8. Looks like a much clearer head and shoulders pattern took place then. And again, the same thing happened in 2007 and 8, is that utilities weren't a leader. They were a lagger, that the broad market had already started heading south. But once utilities saw selling pressure come in, and if you could imagine, I didn't draw a neckline here, once it was broken, then again, Katie barred the door, selling took place, and there was no place to hide in any indice. And so now as we turn the page forward, utilities are doing fine, folks. They're a lot closer to an all-time high. They're only 1% off the highs that took place in the beginning of the late 2017. And so this was 2 years ago that this high took place. And so utilities aren't doing poorly. They're actually reflecting relative strength. And again, they're not leading, they're lagging the frustration in the broad market. But I just want you to be aware that this could be a double top taking place. Again, this is a low odds, high impact pattern. It's a low odds if this is a double top. But if we see selling pressure come in, and if we would draw an imaginary 9-year, 10-year rising support line, if utilities would break that, all of a sudden it would start smelling and walking and quacking a little bit more like 2007 and 2000. So again, I want you to be aware that this could be a topping pattern in the utilities index. We've shared for well over a year now that home builders were a leading indicator before the top in 2007. Actually, I think we'll look at it shortly, everyone, the home construction index, but this is different, but they were still a leader to the downside. It started creating bearish divergences before the market fell apart in 2007. You can see the high last year for home builders took place in early 2018. So they started creating a bearish divergence at this point in time 13 months ago. And so they fell much harder in the broad market. You can see this very steep rally from 30 to 40, obviously a big percentage change, nearly a 30% rally. So it's up against dual resistance at 1. And you can see that this is a daily chart, everyone, that momentum is as high as it's been in over a year. And then we've seen a little bit of weakness. We've seen a couple of bearish reversal patterns. Again, I would favor seeing these reversals on a weekly versus daily basis, but I just kind of wanted to highlight this is a place that as many indices are testing lower highs, new resistance levels, you don't want to see this sector, which has been reflecting a bearish divergence, start selling off at 2. So kind of turning just a little bit from some charting to some bigger picture valuation modes. This, folks, goes back 120 years. Not a bad time frame, and this is from Robert Prechter. But just to kind of give you some perspective that market valuations are still lofty. This is the level in 1929. This was 1937. This is when I was blessed that I got into the business in 1981, when it was just buy and hold, buy your margaritas, and just watch your money, grow. This was the 2000 level. So you can see we're close to the level of 1929. We're definitely below 2000 levels, the dot-com highs, but we're still above 2007 highs. So this does not mean that all of a sudden, oh gosh, the head and shoulders patterns have to come true. No, it doesn't mean that. Why I show you this is just for mental sharpness and empowerment, is that this doesn't again mean this is where markets have to top, but this is historically not where extended 3 to 5 to 10-year bull markets get started. This plays into the hands of being more of looking for inflection points and what we're really trying to help people with. So being a little bit more nimble is what a very high PE ratio would suggest doing. And again, as a reminder, this is a chart that we've shared before, but I just want to share again. This is something that Sir John Templeton shared with me right up here in the late 90s, when he said, Chris, at best the market will be flat for 15 years. I've been puking buy and hold for 20 years when he said that, and I don't like the word hate, so I'm not going to use it. I really, really despised him saying that buy and hold is broke, and you're going to struggle if you're a buy and holder for years to come. I fought it and I fought it. It just frustrated the heck out of me. But the bottom line is this chart ended up being very accurate. And again, he didn't become a multi-billionaire by being inaccurate on big picture trends. But this shows the percentage of assets, the American household in stocks, and then the subsequent, the following 10-year return. And so this, as an example, when I got into the business, let's go down to here. You can see that this was very low. This, the gray indicator was showing that on the left side, 22% of the average household had money in stocks. And so this indicator was suggesting that on the right side, that stocks ought to average 19% a year for the next 10 years. And man, did it come close. And then flip the coin on the other side. When Sir John mentioned that to me in the late 90s, you can see that we're up here, so go to the left, that 50% of the average household net worth was in stock holdings. And so this indicator was suggesting that 10 years out, you ought to average a negative 2%. And it got very close to that. So, you know, where are we now? You can see that the average household is around 45% in stocks. And so it's suggesting from a buy and hold perspective that the S&P will average around 2% over the next 10 years. So let's revisit this, everyone, years from now. This isn't the holy grail, but again, this is perspective, which encourages us to be flexible, nimble, look for inflection points, look for sentiment extremes. This is what this type of thing is encouraging versus putting the money in a really low cost index fund and praying. So last year I started sharing several divergences that ended up being correct, that they were sending a concerning message that to confirm the choppy sideways suggestion, or that stocks would struggle going forward. So this looks at junk bonds on the top, the S&P on the bottom, and just going back here on the left side, you can see that junk bonds were reflecting a negative divergence in this red horizontal band. They went down for a couple of years. You can see while stocks were going up, then there was a 50% decline. You can see for a couple more years, then you saw a bearish divergence in junk bonds again. Then you saw with the S&P going up, and you saw a 50% decline. So now we've seen a bearish divergence again in junk bonds for only the last 5 years, because junk bonds have created a series of lower highs, and lower highs. And while the stock market's doing, you know, the opposite. So this is a very, very long-term divergence. And so this is something that the junk bond market is could be sending a concerning message to the buy and hold prospects of the marketplace. Another divergence that took place in 2007, you'll see on the left side of the screen, is banks created lower highs in 2007, while the stock market at the bottom was heading higher. Then we saw a large decline. Last year, we started highlighting to everyone, hey, we're seeing a bearish divergence taking place in banks. You can see as the stock market was making higher highs. And so, again, banks are close to testing key overhead resistance. And so how could they break this bearish divergence? The first start would be is to break overhead resistance, then break above last year's highs. Until that takes place, the bearish divergence message from banks is still in play. Home construction index, we're seeing a similar message still taking place. You see the divergence prior to the financial crisis here in home construction. And then once the S&P started rolling over, they both continued to head south. They did this a couple of years ahead of time, everyone. Home construction, again, diverged all last year. So it's up against falling resistance. And so the divergence message that sent a cautionary message to stocks from these three key sectors last year is still in play. So one of the things that I cannot explain why, but this looks at the S&P 500 going back into the 90s, that for whatever reason, particularly once the market peaked in 2000, I think that's the one thing I want you to be aware of. Once the market peaked in 2000, the seasonal dates of the first day of spring and the first day of fall started becoming important for key inflection points. And again, I don't care that if we live 200 or 300, 400 years from now, I don't know that we could explain this, but the bottom line is I'm going to stick my head in the sand and say that it can't happen, everyone. But again, you can see that many opportunities to buy and to harvest took place around these seasonal dates. And then once 2003 came along and we started on the bull market from 03 to 07, you'll see that these seasonal dates didn't matter for almost 4 years, folks. But then again, once the top and around the first day of spring took place in 2007, we started seeing some key inflection points around the first day of spring and the first day of fall. And then lo and behold, for the most part, over the last 10 years, the first day of spring, the seasonal dates haven't been helpful or meaningful whatsoever. But I do find it interesting that when we look back on last year, I'm going to interject a new seasonal date, the weekly closing high for the first time that I've been watching this for 20 years, the weekly closing high for 2018 took place exactly on the first day of fall. And then as I've mentioned, and a lot of people talk about, the lows that took place around Christmas or Christmas Eve, the weekly closing low for last year actually took place on the first day of winter on 12/21. So I'm going to pose the question that it's going to take maybe 5, 6, 7 weeks to prove out. But what if, everyone? What do we have this month? What is today, everyone? The 5th? So what is 16 days from now? It'd be the first day of spring, right? March 21st. So it'll be interesting as what if that was an important inflection point? Potentially, what if that's a high? And so again, for a lot of years, the majority of the years, looking at this chart over the last 20 years, the first day of spring and fall was meaningless. I'd waste your time talking about it. But when the bear markets of 2007 were taking place, I don't know why, these inflection points became more important. So let's just watch to see if any certain important action takes place around the first day of spring this year. So speaking of seasonalities, just want to kind of remind everyone that we are in the stronger part of the year as far as February, March, and April. You can see in the green box, seasonality wise are typically good times in the market. We've tried to take several long positions since the first of the year. The majority of them have worked out well. It's nice to see some double-digit gains being put in the books, and some still on the books right now. And so this is nice to see that historically the wind's to our back and nothing has changed. So as we just enter March, you can see that it's the second on average strongest month over the last 10 years seasonally. So between March and April over the last 10 years, everyone, there's been almost a 4% total return in the S&P. So seasonality it's typically been a good time of year. But as I've said each week, I'm not going to invest in seasonalities, alone. Some of the things that we've done the best with is our seasonal stocks. This is a reminder of the stocks that have done well in the month of March. And there's several. There's only one on this list that we're nibbling on right now, and it's Ulta, the second one from the top, ULTA. It looks to be attempting to break from a bullish ascending triangle. You can see that its average gain in the month, median gain over the last 10 years in the month of March is 10%. And you can see right in here that 9 of the last 10 years it's been up in March. So again, the primary focus is the pattern that we see in hand, and then we've set a tight stop just below the top of the ascending triangle that Ulta looks to be forming. I'm watching, I have I've charted all of these. I have buy alerts if we see upside breakouts on all of these, and I'll share some of them in the upcoming days. So one of the things that could be the most positive to try to blow up any head and shoulders topping patterns would come to me from the weakest part of the world. So let's see, and I want you to keep an eye on the financial sector from Europe, because it's been the weakest over the last year. Some would say, well, it was the culprit, I'm not going to point a finger at who was to blame, but the chart on the left is Deutsche Bank, DB, and on the right is European Financial ETF, EUFN. You can see that they didn't make new highs in the fall, so they both created bearish divergences for calendar year 2018. They both started experiencing counter trend rallies starting around Christmas Eve, and now they're both testing falling channel resistance at each two. So the bullish case for stocks in the States is where we discussed earlier, could we be near right shoulder completion? Some of the banks and the S&P we discussed earlier are testing and kissing the underside of potential resistance. What happens to DB and EUFN at 2, I think are going to send really important messages to assets in the States. So keep a close eye on these two folks. I think they'll send important messages. Staying on the lagger theme, facing resistance, that sent bearish divergence messages. I doubt that I'm telling you anything new, that this chart of EEM reflects that we all know that emerging markets have stunk it up. They've lagged the broad market for several years, but EEM still does remain in a long-term uptrend. You can see in the top part of the chart that EEM is still oversold, but similar to the charts we just looked at in Deutsche Bank and EUFN, EEM is facing falling channel resistance in that blue circle as we speak. So again, this is another ancillary piece that you want to look at, or an indicator to watch for a bullish breakout or a bullish message. This would be a price point where the bulls in the States don't want to see EEM fail at falling channel resistance. And I'm not going to bore you a long time with this. EFA has the very similar look to it. So we're going to finish up here. I hope that you've enjoyed today's our monthly Connect series webinar. As I shared earlier, a lot of these indices, I think we shared 3 or 4 potential head and shoulders topping patterns. I have to say, with the advanced decline lines in the S&P, the NASDAQ, and the NYSE at all-time highs, it reduces the likelihood that those patterns are true. But I don't think I feel very obligated that I've got to share some potentialities of those. So it's going to take it would take a break of the necklines of all of those to prove that those patterns are correct, and it'd take nothing more than the breaks above the 261 extension levels to say Chris wasted my time on discussing those topping patterns because they didn't come true. And folks, if these major indices can take out those 261 extension levels, look for a lot of buyers on a global basis coming into the market. So next time I see you on our webinar, we'll be after we'll be into spring. Yahoo, for everybody. I want to thank you for your business, your time, here today, and I wish you good health and happiness and continued good times in the marketplaces. See you all next month, everyone. Thanks again. Goodbye.